Assalamu alaikum, dear students, and good morning. I think if it is good evening anywhere, so good evening as well. This is our second live revision class for AFM March 2025. The topic we started, that is cost of capital. Before we start the class, one student has asked how to manage AFM with other subjects. Basically, you should be making a proper timetable. So if you just make a proper timetable, then obviously subjects are manageable, but you have to make a proper timetable. One student is saying, sir, started AFM now, how to cover the previous chapter? It's very simple. Yeah. You have to follow the plan. You have to follow the planner. If any one of you is not having the planner, please ask the admin, they will give you the planner. Try to follow the planner. Everything is written in the planner. Okay. And let me just a little announcement, then we are going ahead. That is, this is the second live revision class for AFM. So as I mentioned in a very first class, only the first two classes, take them as a warm-up classes. Only first two, okay? The duration is not so long, but believe me, from class number 3 onwards, the duration of the live revision class will increase. It will remain once in a week, but the timing will increase definitely. Plus, the coming live from class number 3 onwards, every class is going to be very interesting because we'll be discussing the latest past papers as well. So, from class number 3 onwards, everything is going to be extremely interesting. But obviously, when you will before attempting any past papers, at least 3 to 4 days before that past paper, I'll share that past paper with you in your relevant WhatsApp groups. So you will be having around 3 to 4 days to attempt those recent past paper questions, and then we'll be discussing in our live revision classes along with our AFM revision as well, because I made a commitment that you will be getting the revision of entire AFM. Entire means entire. So you might have noticed one thing. We have started from cost of capital. Our main course also starts from the cost of capital. Revision sequence will be same like it is in our regular course. With that, we will be also doing the recent past papers. But first, I'll give you the opportunity to attempt the past paper. Then we'll be discussing in our live revision classes. Okay. So this is what we discussed in our very first live revision class. Excuse me, and let's see. Okay, that is DVM. Now, let's say ABC company. That's my favorite company, I would say. Dividend $0.24 per share in 2019. Dividend $0.28 per share in 2020, 0.36, 21, 38, 22, and let's say $0.39. 2023 and 24 is ending, so let's take 24 as well. Time passes very fast, and let me tell you, those are very important message for every one of you. Please try to complete your ACCA as soon as possible. To become an ACCA affiliate, you have to spend proper time which is required to complete ACCA. And let me tell you one thing. The earlier you will become ACCA affiliate, you will get the more benefit. You will get the more benefit, no one else. Only you are the one who is going to reap the benefits. Because if you take more time to become an ACCA affiliate, if you're taking more time than which is obviously required to become an ACC affiliate, so it's only your loss. Nobody else is will face that loss. You will be the only one who will be facing this loss, because most of the time what happens, your opportunity cost is very high. Your opportunity cost is very high. So make sure, please try to become ACC affiliate as soon as possible. Can we apply for research analyst, investment analyst jobs once? No. Please, right now I would say, see, let me tell you, what is a suitable time for doing job and everything? If any one of you is having no issue as far as financials are concerned, then I would request, try to first become ACC affiliate, then apply for the jobs, do whatever you want to do. Because sometime with the job it becomes bit difficult. So if your family is supporting you and everything is fine, so right now you should be focusing only on qualification and try to become ACC affiliate as soon as possible. But otherwise, if, of course, if something is wrong, then you should be doing job and supporting your education. Okay. So now look at this. Student examiner has given you the information of number of dividends. Okay. Current share price. 12.4 cum div. The requirement is to calculate KE. Now listen carefully. In dividend valuation model, obviously we assume that annual dividend growth rate is constant. So whenever you have been given information like this, so you have to calculate the growth rate. And by calculating that historical average annual growth rate, you have to consider all the dividends. What is the formula mathematically? Let me show you. Annual dividend growth rate is equal to last or you dividend, last dividend per share divided by first dividend per share. Then 1 upon n minus 1. Basically, if examiner has given you the data of 10 years, for example, then power will be 1 upon 9. Because the growth actually starts from the second year. In a very first year, there's only a dividend. So if examiner gives you the information of 5 years, then power is going to be 1 upon 4. Minus 1. So this is the formula of calculating annual dividend growth rate. Last dividend per share divided by first dividend per share 1 upon n minus 1. Now let's apply. Then I'll show you how to apply in the Excel as well, so that you should not have any issue at all. The last dividend is 0.4, okay? In our question. The first dividend is 0.24. The first dividend is 0.24. Let's count the time period. 1, 2, 3, 4, 5, 6. Students, we have been given the information of 6 years of dividend. So what will be the power? The information is 1, 2, 3, 4, 5, 6. So what will be the power? Can I say 1 upon 5? Yes or no? Now listen carefully, please. You have to be little bit good in maths as well. Logically, 1 upon 5 means 0.2. Did you get this point? 1 upon 5 means 0.2. If you just divide 1 by 5, you will get 0.2. Is this clear to everyone? 1 upon 5 actually means 0.2. Please quickly reply, students. Okay, that's clear. Great. So actually, the power is 0.2. Now, please, you have to listen to me carefully how I'm using the calculator. Then I'll go to the Excel as well. 0.4 divided by 0.24. I'm getting a result of, let's say, 1.666. Now, power. 0.2. So actually, the answer of this whole bracket with the power, I'm getting 1.107, let's say 6 is 5, 6. So, okay, minus 1. So we'll get 0.10756 multiply by 100. Multiply by 100. This will give us 10.756%. So the annual dividend growth rate is 10.756%. After that, it's very easy. We know that K is equal to, what is the formula, students? D naught 1 plus G upon P naught plus G. And P naught is the current share price X diff. And we did mention in the previous class, if nothing is mentioned, then given share price, we will always assume X div, excluding dividend. In case of cum dividend, examiner has to mention that. Like it is mentioned here that given price is the cum div, 12.4 minus the 0.4. The last year is the latest year. So actually we are working for 2024. We are in 24 working for 2024. Okay. K is equal to current dividend into 1.10756 divided by 12 plus 0.10756. Now let us use the calculator. Let's see what percentage we are getting. 0.4 multiplied by 1.10756 divided by 12 plus 0.10756. Students, I'm getting 0.1444 multiplied by 100. So please recheck also. I want you guys to also confirm this. I'm getting K 14.447%. Please, can you confirm this?
Yeah, it's true.
Students, I'm waiting for your confirmation.
Yeah, it's true.
Waiting.
Your key is 14.44.
Waiting for your confirmation. That's true. It's okay. Now, let me just let's go to the spreadsheet, quickly see how to calculate. Actually, only one thing, that is the growth rate. Let me go to bring the Excel sheet here. Let me share this as well. Okay, I hope everyone can see this Excel sheet. That's great. Everyone can see this spreadsheet, Excel sheet, yes or no? Please quickly reply so that there shouldn't be any problem. Okay, great. We know the data, so I'm just going for the answer. First, we calculated the annual dividend growth rate. G is equal to bracket. The last dividend is 0.4 as far as I remember. Divided by the first dividend was, let me check. First dividend is 0.24. Okay. So 0.24 bracket close, shift and 6 power 1 upon 5 means 0.2. Okay. Then minus 1. Look at this, student. I'm getting this. It's the same. If you convert that into a percentage, and if you want that percentage into the points, I hope it is clear to everyone how to get this growth rate. Yes or no? Please quickly reply. Great. Now let me show you something. If I convert that into journal, this journal is here. Why I'm doing this, I'll tell you. K is equal to D naught is 0.4, then multiply by 1.10757, if I'm not wrong. 1.10757. Then we divided this with the current share price, which is 12. Then plus this. Now, let me convert that into a percentage. So I'm getting this. I hope it is clear to everyone how to calculate annual dividend growth rate on the spreadsheet, how to calculate KE. Quickly reply, please. Steps are clear to everyone? Waiting, students, I'm waiting. Okay, that's great. Okay, great. Let's go back to the OneNote. So I hope everyone can see this OneNote. Sir, it is important to do directly, or can we do step? You can do it step by step. Yes, you can. But I think we did the step by step. First, I calculated annual dividend growth rate. Am I right? Then I calculated KE. So that's perfectly fine. So we calculated growth rate separately. Then we went for KE. So, okay, now come here. Now, student, listen carefully. There is another situation of calculating annual dividend growth rate, that is by using Gordon growth model. We can calculate annual dividend growth rate. So what is the Gordon growth model? G is equal to B RE. Basically, this is we use in FM. RE, return on equity. In AFM, we change this. G is equal to B KE. That is in AFM. So by using Gordon growth model, we can calculate annual dividend growth rate. Now, before I start the discussion on Gordon growth model, some of, not all, but few students, they just get confused and they start thinking, when do I need to use the Gordon growth model? When do I need to use the method which we have just discussed in the previous question? Please, student, it depends on the data. Simple, pure and simple answer. So you will be using a formula. You will be solving the question according to the data. Another most frequently asked question is, sir, I can calculate KE by using capital asset pricing model. I can calculate KE by using DVM also. Which one I am going to use it? Again, depends on the data. If your examiner gives you the information of only CAPM, so obviously for calculating KE, you will be using CAPM. If examiner gives you the information of only DVM, then you will be calculating KE by using dividend valuation model. It never happens, or rare chances are there. Now listen to me carefully. That examiner has given you the enough information that by using CAPM and let's say by using DVM, you can calculate KE. If this is the case, then we will always prefer the preference is given to the KE from CAPM, because CAPM is assumed to be more superior than dividend valuation model, because DVM is having more limitations as compared to CAPM. The good thing in CAPM is having a measure of systematic risk. DVM does not have the measure of systematic risk, because in CAPM, by looking at equity beta, you can tell us investment is how riskier the investment is. We do not have such things in DVM. So if you come across a question where there is so much information, which I hardly think the examiner is going to do that, but just I want to answer. If examiner has given you so much information that you can calculate KE by using CAPM as well as DVM, I am going to calculate KE by using both the models. After that, I will write a single line, that is KE from CAPM S given preference over DVM due to limitations of DVM. That's it. Then in then in cost of capital, there will be only KE from CAPM. I hope I have answered all the confusions. Now, Gordon growth model. So G, we know that there is annual dividend growth rate. B is the retention ratio. B is the retention ratio. Now listen carefully, students. If company says we pay 40% dividend, if company is paying the 40% dividend, it means they are retaining 60%. If company says we are paying 30% dividend, it means they are retaining 70%. Another concept is organizations they retain to reinvest. Repeat, organizations they retain to reinvest. It is even an individual does the same thing. Then individual retains for reinvestment. So repeat, organization they retain to reinvestment. Now look at this. B is equal to 1 minus payout ratio. Because I just said if company is paying 40% dividend, it means they are retaining 60%. If company is paying 30% dividend, it means they are retaining 70%. It means if I know the payout ratio, then 1 minus payout ratio will give me the retention ratio. Now payout ratio. How do we calculate payout? Very simple. Organizations, they provide return in the form of dividend from their earnings. So the formula is very logical. Organizations, they provide return in the form of dividend from their earnings. So dividend per share divided by earning per share. Obviously, return will be in the form of dividend from earnings. So it makes sense. Dividend per share divided by earning per share. KE, obviously, we know that cost of equity. So by using Gordon growth model, we can also calculate annual dividend growth rate. Now, one more concept you need to know, what is that? If organization distributes all its earnings, then retention ratio is 0. Obviously, if someone is earning whatever and just spends the entire amount, there's no saving, there's no retention. If there is any organization which distributes all of its earnings, then retention ratio will be 0. Now listen, students, carefully. When the retention ratio will be 0, then G is equal to 0. There will be no annual dividend growth rate because there is no retention. Logically, when you reinvest, and from that investment, you will be earning more returns, and that will increase your capacity, your ability to give more dividend. But obviously, when you're not retaining anything for reinvestment, so growth rate is 0. We're gonna come here. Okay, another thing is, how do we calculate EPS, earning per share? Very simple formula is in FM and AFM for EPS. Otherwise, we know that there's entire IAS 33 for earning per share. Simply take profit after tax divided by ordinary shares. And this formula is only applicable in FM and AFM. Otherwise, we know that is profit after tax minus preference dividend minus NCI in case of group accounting divided by weighted average ordinary shares. But that is not applicable in FM and AFM. Very simple. Profit after tax divided by ordinary shares means total ordinary shares. Okay, now. Let's say we have RF 6%. I want everyone to solve this, okay? RM 15%. Equity beta 1.5. Dividend $2. Earning per share EPS is, let's say, 8. What is the question? D naught is dividend per share. Earning per share is 8. The requirement is I need P naught. Please, I want everyone to solve this. I'm giving you 2 minutes to do this. RF is 6%, RM 15, equity beta 1.5. Dividend per share is $2, earning per share is 8. I want everyone to calculate P naught, please. Let's see the first answer from the student. That is 41.65. What about others? Students, whenever you have been given time to attempt the question, do attempt it, please. Another student is getting 46.7. One is getting 41.65. What about other ones? I want everyone to attempt this, please. I want everyone to attempt this. Everyone means everyone. And students, from live revision class 3 onwards, I need your time, okay? The time duration of the live revision class will increase. It will remain once in a day, but once in a week. That is on every Sunday. But obviously, time will increase, duration. Okay, let's solve together. We got two different answers from the students. Let's see. Let us first calculate K by K is equal to RF is 6, RM is 15 minus 6, then 1.5. Logically, K will be more than RM. Yes or no, students? Because of by looking at equity beta, we can say this. Because equity beta is more than 1, when equity beta is more than 1, it means your investment is more riskier than the market. When my investment is more riskier than the market, then I'm going to demand the return which is more than the market. Students, I'm getting K 19.5. Just put a percentage sign. Okay, now
Yeah, it's correct.
1 minus payout ratio. 0.75. Annual dividend growth rate by using Gordon growth model 0.75 into 19.5%. Let's see. Students, I'm getting 14.625%. I'm getting 14.625%. P naught. We did discuss this formula previously in our first live revision class also. P naught is equal to D naught 1 plus G Ke minus G. So P naught is equal to D naught. Current dividend per share is 2 into 1.14625. 0.195 minus 0.14625. Just if I show you more calculation, 2 multiplied by 1.14625. I'm getting 2.2925. In the denominator, it is 0.195 minus 0.14625. In the denominator, I'm getting 0.04875. Let's see what is the P naught now. 2.2925 P naught. Students, I'm getting 47. So I think with a little bit rounding off, maybe students are having different answers. I hope this calculation is clear to everyone. Quickly reply, please. This calculation is clear to everyone, yes or no? Okay. So students, we have discussed K, we did discuss DVM also. Only one is left, that is MM plus tax equation, which obviously we are going to discuss. As I mentioned in a very first live revision class also, MM plus tax equation is the alternative of CAPM. So we'll come to that. Don't worry at all. Now, look at this. How do we calculate cost of capital? How do we calculate cost of capital in case of diversification? We have to discuss that. Plus, before the discussion of how do we calculate WACC in case of diversification, plus we need to discuss if a business is already diversified, how do we calculate WACC? Before doing the discussion on both of these areas, let us first quickly discuss how do we calculate KD1 minus T, because there is a possibility that company is raising the finance in the form of debt, which they should be doing it because debt is a cheaper source of finance as compared to equity. So if company raises the finance in the form of debt, then the cost which they have to bear, that is KD 1 minus T, that is cost of debt after tax. Quickly, can you quickly reply why we have written KD 1 minus T? Why not only KD? Can I say when a company raises the finance in the form of debt, then fixed payment of interest results in tax saving? Great. Now, student, please listen carefully. In case of debt, when we are calculating KD1 minus T, so basically there are number of debts. There are different types of debts, and in each type of debt, calculation of KD1 minus T will be different. So let's discuss one by one. Number one is bank loan. So in case of bank loan, calculating KD1 minus T is extremely easy. For example, if it is a 10% bank loan, and let's say the tax rate is 30%, and we are asked to calculate KD1 minus T, so very simple. Just take 10%, 1 minus tax rate. So your final answer is going to be 7%. So in case of bank loan, just take the percentage of interest on bank loan and multiply that with 1 minus T. You will get KD1 minus T. Another thing is, in case of bank loan, we always assume that book value of bank loan is equal to market value. Why? Because when we calculate cost of capital, we always use market values, number one, and number two, bank loan is an instrument which is not traded at a stock exchange. There's no buying or selling of this bank loan. So whatever loan your company has taken from the bank, it is just in your books. There's no trading is happening on that bank loan. So basically, it does not have a market value. That is why we assume that book value of bank loan is equal to the market value. Second debt is again important. Irredeemable bonds. Now, how do we calculate KD1 minus T in case of irredeemable bond? Look at this. KD1 minus T is equal to I multiplied by 1 minus T, T naught 100. KD1 minus T, simply cost of debt after tax. I is the cash interest rate. Cash interest. How do we calculate cash interest? Let me show you. You will have to take the par value of bond, nominal value of the bond. Another name is face value of the bond. So par value of bond multiply by the coupon rate. Coupon rate is the rate which is written with that bond. So how do we calculate cash interest? You have to take the par value of the bond. Another name for the par value of the bond is nominal value of the bond. Another name is face value of the bond. Most of the time it will be 100. I'm not saying always, but most of the time. Multiply by the coupon. Coupon rate is the rate which is written with the bond. So just multiply both of them, you will get cash interest. P naught. That is current bond price X interest excluding interest. Whenever the bond price is given, nothing is mentioned, we will always assume that given bond price is excluding interest. In case of cum interest, bond price, it will be mentioned in the question cum interest. So nothing is mentioned, then simply we assume it is X interest. Okay, now. Let's say we have 8% bonds, 8% irredeemable bonds. Par value 100, comma. Current bond price is 115. Tax rate is 20%. Required KD1 minus T. Students, quickly answer, please. What is KD1 minus T? Okay, student is saying 5.6. What about others? Let's see what about others. Okay, they are also getting the same result. Let's see. 5.6. KD 1 minus T is equal to, obviously coupon rate is 8%, par value is 100, so it becomes $8, 100 multiplied by 8% is 8 into 1 minus tax rate divided by 115. Nothing is mentioned, and given price is X interest multiplied by 100. Let's see. In the numerator, 8 multiplied by 0.8, because 1 minus 0.2 will give us 0.8 divided by 115. So 5.56, 5.6 is perfect. Great. So we are getting 5.56% is just perfect. Okay. Now, let me tell you one more thing. Please, what I'm writing, just watch it. For example, if I'm just writing KD is equal to I upon P naught. By using this, obviously I can calculate P naught. If examiner just gives me the KD, obviously he has to give me the KD, cost of debt. Cash interest, I can calculate P naught. Actually, it depends on the information, how we are utilizing that formula. Look at this, P naught is equal to cash interest upon only KD. Now, keep watching it. Some of the students, they just get confused that where is 1 minus T. Let me put that also for you. Just keep watching. Okay. We can also, now what is happening? This KD 1 minus T if I write like this, so logically this is being cancelled out. Are you getting this point? So just look at this, I upon KD. But obviously it depends on the question if examiner is asking you to do that. Otherwise, obviously, we will not be doing. Obviously, I'm not expecting that examiner is asking you to calculate P naught of irredeemable bond, but it can be. So better to prepare for everything. Okay. Sometimes what happens, few small concept can disturb you if you don't have those concept in your pocket. So I want your pocket to be deep with concepts. Okay. Uh, Deep when it comes to money, for that you have to work hard, students. But as far as concepts are concerned, so I'll make sure your pocket should be deep with concepts of financial management. Okay. And other deep pocket, you have to work for that. Third type of bond is redeemable bond, which is very important. Redeemable bonds. Now, student, you have to listen carefully. In case of redeemable bonds, in case of redeemable bonds, how do we calculate KD1 minus T? In AFM, in AFM, the first priority of calculating KD1 minus T is by using YTM approach. Repeat. In AFM, the first priority of calculating KD1 minus T for redeemable bond is YTM approach. YTM. Yield to maturity. Yield means return. How do we calculate YTM? Let me just tell you. So first priority is YTM. Actually, YTM means yield to maturity. Now try to understand. YTM actually shows the return required by the debt holders. YTM actually shows the return required by the debt holders. Obviously, if I know what is the return required by the debt holders and my company is the borrower, so the same thing is cost for me. The return required by the debt holder is cost for my company. So right now I'm just thinking what return debt holder they will be asking. Now, how debt holders they actually decide their return? It's very simple and very logical. YTM is equal to RF. This RF is return on government bonds. Now listen to me carefully. If your company has issued a bond, is issuing a bond of redeemable bond, let's say having a maturity period of 4 years. So the debt holder will see number one thing that at 4-year maturity, what government is offering. Then obviously, if that investor is going to invest in your company's bond, so that particular investor will be expecting more return than the government bond. We know that government bond is not there's no risk in investing in government bond. But when it comes to your company, at least the company where I'm investing it is, we obviously will say it is riskier than the government. So YTM is equal to RF plus CRP. CRP is credit risk premium. Credit risk premium. And CRP, credit risk premium, another name is default risk premium, will always be given to you. CRP, default risk premium, will always be given to you. Now listen to me carefully. If someone asks you during an interview, okay, that is there any way to calculate CRP? The answer is yes. By using Black-Scholes option pricing model, we can calculate CRP. It is not in our syllabus, but I'm just giving you the little bit more information. But obviously, if someone asks you the question during an interview, is there any way to calculate CRP? The answer is yes. By using Black-Scholes option pricing model, we can calculate CRP. In AFM, CRP will be given to you. So how do we decide YTM? If your company's bond is having a maturity period of 5 years, so step one, we will see at 5 years maturity what government is offering, plus CRP, credit risk premium. Now another point is CRP is always given in the basis points. And you can say it's a language, 100 basis points, they're equal to 1%. So you need to know this maths. It's a particular, you can say it's a language. If I give you the example of a language, for example, I'm just giving you an example. Call, we know what is the meaning of call, but when I say call option, the interpretation changes. Right to buy. Right to buy. You can see that I've just written the call option. What is the interpretation? Right to buy. So it's a particular language. Put option, right to sell. The same thing is happening here. 100 basis points, they're equal to 1%. So this CRP credit spread will be given to you in basis points. Now repeat. How do we calculate YTM if your bonds are having maturity period of let's say 3 years? So number one in the question, I'll see what government is offering at 3 years maturity. That will work as RF plus CRP. And this is applicable on redeemable bonds. The first priority, I'm repeating it again and again. Please, you student, listen. The first priority in AFM is always YTM. Now listen, yield to maturity. This is the return required by the debt holder. The same thing is KD for my company. I'm the borrower. Obviously, once you have calculated the KD, after that you just need to do 1 minus T. Once you have calculated the KD, then obviously you just need to do 1 minus T. This is AFM approach. Okay. Then how do we deal with redeemable bonds? I was just explaining that call option is a language. Like the meaning of call option is right to buy, put option means right to sell. It has right now it has nothing to do with this topic. I was just explaining one point that CRP is given in basis points. It's a language, 100 basis points that are equal to 1%. I was just giving that example. Okay. Now, please, please, you have to listen to me carefully. If YTM approach is not applicable, please concentrate on the explanation, students. For redeemable bonds, if YTM approach is not applicable, then I'll go for FM approach, that is by using IRR. I'll calculate KD1 minus T. But again, I'm telling you, I'm not going directly on IRR. My first priority will remain YTM in AFM. But if YTM approach is not applicable, then I'll go for FM approach. Now look at this. Please, student, I'm repeating it again and again. The first priority is not FM approach. The first priority is YTM, AFM approach. In FM, what happens? By using IRR, we calculate KD1 minus T. Now, how do we calculate KD1 minus T? By using IRR. But please, when YTM is not applicable, then I'll go for this approach. Let me just write it. T0, T1, T2, T3, assuming maturity period is 4 years. Cash flows are very important. T0, market value of bond. I'll take market value bond. Interest 1 minus T. Interest, that is cash interest. We know that. How do we calculate cash interest? Let me write here. That is par value multiplied by coupon rate. So interest 1 minus T. Interest 1 minus T. Interest 1 minus T. And here it will be interest 1 minus T plus the redemption amount. Plus the redemption amount. Now listen. When we say redemption amount, so never forget one thing. For this redemption amount, I always say RTQ. For the redemption amount, I always say RTQ. Read the question carefully. Now you might be thinking, sir, why you have not taken the C? Oh, it's okay. RTQ is okay. Read the question carefully. Why I'm saying there's a reason. Number one, nothing is mentioned, then redemption will be at par value. Obviously, if the question says par value, so it's okay. Nothing is mentioned, redemption will be at par value. Second, redemption could be at premium. But in case of premium, premium will be mentioned in the question. So redemption could be at premium. Third possibility, please listen carefully. There's a possibility that given redeemable bonds are convertible bonds. There's a possibility given redeemable bonds are convertible bonds. In case of convertible bonds, actually investors, they have two choices. One, at maturity, they can convert convertible bond to the ordinary shares, or they can go for redemption amount. Can I say if I'm the investor of convertible bonds, for example, and I have two options. One, let's say at maturity, I can convert the bonds into shares, or I can go for redemption amount. Can I say then investor will choose the option in which investor is getting the more benefit? If conversion value is higher, I'll go for the conversion value. If redemption amount is higher, I'll go for the redemption amount. So it means the third possibility is conversion value. So redemption amount could be conversion value, but when conversion value comes, please listen the explanation carefully. Number one, the given bonds are convertible. Second, at maturity, the conversion value is more than the redemption amount. In that case, conversion value comes. Fourth point, which I have never seen, but I'm just writing it. Redemption could be at discount. So only the first one, nothing is mentioned. Redemption will be at par. Otherwise, it could be at premium, but it will be mentioned. Conversion value can come, but what are the conditions for the conversion value? Number one, the bond is a convertible bond given in the question. Second, at maturity, conversion value is more than the redemption amount, and there's a slight possibility of a redemption at discount. If it is the case, it will be mentioned in the question. After writing all these cash flows, you just need to use is equal to IRR formula from your spreadsheet, because that formula is given to you. You will get KD1 minus T. I'll show you right now. And let me give you one more explanation, but please, you have to listen to me carefully. If you are not taking 1 minus T here, okay, any question? Sir, in case of redemption discount, will the interest offered? Yeah, discount is only possible normally when company gives us a really high interest rate. Okay, look, I1 minus T, I1 minus T, I1. If you're not taking 1 minus T here, for example, if you're not taking 1 minus T here, if you're taking just interest, then the final answer by using IR or whatever you will, the final answer will not be KD1 minus T. It will be KD. Then you have to perform one more step. After calculating KD, then you have to do 1 minus T. So both the approaches are 100% acceptable. I'll stick to the first one, which I've just showed you. One interest, 1 minus T interest, 100% acceptable. Even though the result will not be same from both of them, okay? But it is more than 100% acceptable. You need to know what are you doing. There's one professional marks for data evaluation. There's one professional marks for analysis and evaluation. Analysis and evaluation means the way you are solving the question, it should look like that you know the data very well. It should look like what are you doing. Got it? For that, you'll be getting one professional marks for analysis and evaluation. Analysis and evaluation means you know the data very well. You know that what exactly you are doing it. Like I'm teaching right now AFM, so I exactly know what I'm doing it. So by using IRR formula, I can calculate KD1 minus T. This is FM approach, but again, this is not my first priority. But let me show you how to perform this formula on the spreadsheet. Let's go to the Excel. I hope everyone. Oh, no. Even I cannot see. So, how can you see? This is the one. I hope everyone can see this spreadsheet Excel. Let's say we are calculating KD. I hope everyone can see this spreadsheet. Please quickly reply because sometimes what happens that student they cannot see, then video will not. Okay, you can see. Thank you. Thank you for the confirmation. The data I'm just assuming, okay? 0, 1, 2, 3, and 4. Let's take the cash flows. Let's say the market value is 112. Assuming a par value, we know that it is 100, and let's say the cash interest is 8%. So what I'm doing, let me show you. 100 multiply by 8%. Multiply by. Let's say the tax rate is 20%. Keep watching. If the tax rate is 20%, can I say 1 minus T will give me 0.8? Yes or no? If the tax rate is 20%, okay, the answer is yes. Keep watching, please. Oh, I should have come till here. Okay. In the last year, I have to take the redemption amount as well. Assuming the redemption is at 5% premium. I'm just assuming, okay. Redemption is at 5% premium, par value is 100, so it's going to be 105. Now, I need KD 1 minus T is equal to IRR. Just do this. Shift and select all the values. Shift and select all the values, close bracket, enter. Students, I'm getting 4%. Is this clear how to apply this IRR formula? Okay, what about others? I hope it should be clear to everyone. But again, I'm repeating the concept that FM approach is not our first priority. The first priority is YTM. Let's go back to the OneNote. Okay, we are back. Water. Okay.
Sir,
Okay,
can
sure.
you
One
can
more
hello,
possibility.
hello sir.
That is preference shares.
Hello sir.
If your company raises the finance in the form of preference shares, then obviously you have to bear the cost. Not seen in AFM, but quickly let's have a revision. KP is equal to D naught upon P naught. KP is the cost of preference shares. Another interpretation is minimum return required by preference shareholders. So D naught. Preference dividend per share. Preference dividend per share. P naught current. Preference share price. X dividend. Another thing is, logically, when you are using this formula to calculate KP, then logically, your preference shares are irredeemable. Logically, when I'm using the formula KP is equal to D naught upon P naught, just try to recall the formula of irredeemable bonds. Only difference is, obviously, tax does not come in case of preference shares. In case of irredeemable bond, we actually use the same formula. Exception was the tax rate. So KP is equal to D naught upon P naught. Actually, we are using this formula is for irredeemable preference shares. Now listen to me carefully. I've not seen, but I'm just giving you for the sake of knowledge. If someone asks you, the preference shares are redeemable and redeemable, they are possible. If the preference shares are redeemable, then by using IRR, you will be calculating KP. Again, 1 minus tax does not come in case of preference shares, either they are redeemable or irredeemable. Even though we know that on the basis of accounting, on the basis of substance, we say that redeemable, they are debt, but taxation authorities, they don't accept your redeemable preference shares as debt, they take them as equity. So that is why the dividend payment and trust payment on redeemable preference shares will not save the tax. So that is why either it is irredeemable or redeemable preference shares, there will be no taxation. Concept is KP, D naught upon P naught. This formula is for irredeemable preference shares. In case of redeemable, I'll be using a IRR formula, which we have just seen. Okay. A small question. Let's say we have 4%. And in exam, nothing is mentioned. We always assume given preference shares are irredeemable. In exam, nothing is mentioned. Only preference shares is written. We always assume given preference shares are irredeemable. 4% preference shares. Par value is $0.4. Current share price is let's say $1.64. Okay, make it cum diff. Nothing is mentioned. We always assume X diff. In case of cum diff, it will be mentioned like it is mentioned here. Please, now I really want everyone to calculate KP quickly. I need KP, cost of preference shares. Students, I need KP, cost of preference shares. Okay, let's see what is the answer. It's 2.5%. One student is saying. Final answer will be multiplied by 100. Let me show you so that you can get percentage. Okay. Number one, 4% multiplied by par value. So if I take student, I'm getting a dividend 0.02. So preference dividend per share is 0.02. 0.64 minus 0.02. Because it is cum diff, we have to make it X diff. 0.62 multiplied by 100. 0.02 divided by 0.62. Students, I'm getting 3.2258. What about you? Please reply. 3.225, then 8. Okay, make it 6. Is acceptable. Great. Okay, students, now just last 2 minutes, few announcement. Number one, if you have attended the first live revision class, so I hope you should have noticed one thing. Today's class duration is longer than the first one. Yes or no? Today's class duration is longer than the first one. Agreed. Second, as I mentioned earlier, from third class onwards, obviously, I need your time, but I just need your time once in a week. We'll be discussing, inshallah. Another thing is, you should have noticed one thing. Almost, I'm discussing each and every concept of cost of capital. I'm not leaving anything. Either it's a small concept, it's a big concept, we are covering each and everything. And just let me tell you one thing for the sake of your knowledge, and then I'll say something. Look at this. Try to understand a very important. I'm just answering one question. What is that? Please keep watching. Look at this. What this does not look like. Look at this P naught. I want to tell you one thing. Number one, dividend valuation model K is equal to D naught 1 plus G P naught plus G. Keep watching. This P naught is, can I say, current ordinary share price X div. Second, in case of irredeemable bond, KD 1 minus T is equal to I 1 minus T. Again, the symbol is P naught into 100. Keep watching. Now the P naught shows current bond price X interest. Third, KP is equal to D naught upon P naught. Now the P naught shows current preference share price X div. Now listen carefully. P naught for ordinary shares, P naught for the bonds, P naught for the preference shares. If someone asks you the question, why we are using the symbol P naught, what it shows? Now listen carefully. The symbol P naught is a generic symbol in the financial management which is used for ordinary shares, dividend, and preference as well. Proof is in front of you. P naught for the preference, ordinary shares, P naught for the bond, P naught for the preference shares. So the answer is, why we are using P naught? The answer is P naught is a generic symbol in financial management. You can see that for ordinary shares, the symbol we use, that is P naught. Because someone can ask you a question, why P naught? Why not T naught? Why not C naught? The answer is P naught is a generic symbol which is used for ordinary shares, dividend, and preference shares. Like in mathematics, we have two generic symbols, that is X and Y. So we do have a generic symbol in financial management as well, and that is P naught. Another question is there any area of the financial management where we will replace this P naught generic symbol with another symbol? The answer is yes. In Black-Scholes option pricing model, the symbol P naught will be replaced with another symbol, that is PA. So in the entire financial management, there is only one area, that is Black-Scholes option pricing model, where this P naught symbol will be replaced with PA. So that is just giving you a very insight in knowledge. Actually, now you know the reason of P naught as well. Why do we use P naught in financial management? Okay, now just last 30 seconds. Now, students, listen carefully. Only for the coming Sunday, there will be no live revision class. Only for the coming Sunday. There's a reason behind that. Because the coming Sunday, we have ASA, Abil School of Accountancy. We have kept a meetup at Kuala Lumpur. I'll be traveling for Kuala Lumpur for meetup, inshallah. So just for the coming Sunday, there will be no live revision class. But after that, inshallah, on every Sunday there will be live revision class, and we'll start from here. And timing duration of the class will increase. So only for this coming Sunday, there's no class because of the meetup in Malaysia, that is Kuala Lumpur. So I hope it is clear to everyone, and please keep watching your pre-recorded lectures. Follow the planner which admin has shared with you If any one of you is not having a planner, do ask the admin. They will give you the planner. They will give you the planner. In the next class, actually, we'll be doing two things, inshallah. One is the remaining area of cost of capital, plus we'll start investment appraisal. Topic for the coming class, two. One is remaining area of cost of capital plus investment appraisal. Is this clear now? The topics which we'll be discussing in the coming class. Cost of capital plus. Yeah, don't worry at all. Don't worry at all. We'll discuss. We'll discuss. Don't worry. Timing, everything will be decided. Don't worry at all. Actually, there are some of the students when they attend the live revision class, so their timing is in Pakistan it is 11 a.m., but in their country it is 6 a.m. So we have to consider that also. Okay, students. So thank you very much. I hope everything is clear to everyone. So see you all inshallah in the next live revision class as well. Thank you. Have a nice life, students. Okay, Allah Hafiz. I always say have a nice life rather than have a nice just one day, because day is very small. The life is itself very small. So I pray that every one of you have a nice life. Thank you.